I certainly do look forward to the day when I can be asking everybody if they had a chance to get their sandwich or their smoothie or whatever we're serving, and we can be doing this in person. I certainly miss that opportunity to interact face to face. But someday, hopefully not too much longer. Let's go ahead and jump into the presentation today. There's going to be two parts to it. The first part is the market recap, and the headline for the title there is that the risk-on rally continues. And when I use the headline, the risk-on rally, what I mean by that is that we have some days, months, quarters where risk gets rewarded, and then we have others where risk gets punished, and that's really the pendulum swinging back and forth. We do believe over the long run that taking risk in the stock market in a diversified way is a rewarding thing to do, and I'm going to talk about what that looks like for the future. What we're going to do is go through a lot of different parts of the presentation, starting with the blended benchmark results. We'll talk about the timeline of events, and we'll just get more and more granular and more detailed before we switch to the market outlook, where we take a look forward. So just looking at the blended benchmark results for the last 3 months, ended September 30th, what you can see there towards the bottom is that the global equity index did terrific. That's about a year's worth of returns. In fact, that's almost exactly what we think we'll get is the annual average going forward over the next 20 years for being invested in the global stock market. And we got that for the quarter. Now, we were even up a little bit ahead of that. Now we've given some of that back. The market has certainly become volatile again. But as of September 30th, that's where we stood for 3 months. Now, we did manage to eke out a very small and positive return from the fixed income index. I'm not so sure we'll have very many quarters like that going forward. Certainly, it's been a terrific year in the sense that the collapse of interest rates has meant that anything anybody owns in the fixed income world becomes worth a little bit more when rates plummet. So that's a one direction kind of a thing. And again, we'll talk about that more as we go forward. As you look out to the 1, 3, 5, and 10-year returns, it's just amazing how that can camouflage what has been an absolutely crazy year in terms of how the markets have behaved, not to mention the emotional stress that people have been under with the pandemic. But as it stands right now, we're all set for that volatility to completely disappear from annual tables and charts of how the stock market did. But we're going to go into what's actually happened here in a little bit more detail in the slides that follow. So let's talk a little bit about the past year and look at a chart here. You'll see the big dip. Nobody, I'm sure, has forgotten the big dip. If you're one of those investors that likes to look at your accounts on a daily basis, you'll remember the emotion around it for sure. But we wanted to put some numbers to it and kind of connect that to the headlines that we were seeing. And of all the headlines, and there's been so many this year, there's really 3 that I think stood out to me from the perspective of investing. And of course, the first was the announcement that there was this virus going around that seemed to be something novel, something new. And gradually we learned more about that, and it got on more and more people's radar. We were even talking about it, wondering what might happen when we were meeting in January and February for the big annual market report in person, for those of you that were able to attend that. Well, didn't take too long for the market to figure out what it thought about it as it spread around the world. And we had this just amazing market plunge. Certainly many parts of the market were down about 40% at one point. Well, what turned that around was really the Federal Reserve. And they used some words that I've never heard before and are still part of their pledge for the future. And that is that they will do whatever it takes with infinite money. So any organization, any government entity, any central bank, as powerful as the Federal Reserve that pledges to do whatever it takes, ought to get some respect out of the markets for that. But the words infinite money really ring in my ears as just kind of an amazing offer to support the economy. And the economy began to recover slowly as new cases for the virus also went down but the markets reacted immediately and in a significant way, and the V in the recovery started, and it's been kind of a rocket ship upwards since then. But there was another Fed announcement, also shown here in green on page 5, that I think really didn't get much attention in the press, even in the financial press, and that was a new policy by the Federal Reserve. We're going to get into that in the second part of the presentation here, but I think that might be some of the most important news for investors for perhaps the next half a decade, and it definitely colors what we're going to expect out of the market. So we'll jump into that here in a few minutes. Looking at the long term of the last couple of decades, this volatility this year certainly shows up on the chart as big enough to get your attention, but I wonder how many of us remember what we were looking at last year when we got together at this time. So on the next chart, what we'll show you is when we were speaking last year in October and November, I was showing this chart, which looks almost exactly like the chart that we're just now looking at. So if we rewind the calendar 12 months and talk about where we're at, you'll see that there had been a big dip, and then the market had recovered. And for those of you that don't even remember the dip, and you can be forgiven for not remembering it, although for a lot of people it was a very traumatic thing at the time, the Federal Reserve was starting to let interest rates tick up, and the market was not liking what they did. I'd even given a few presentations about how I thought the Federal Reserve had really just become a market follower and was becoming somewhat irrelevant. Well, they decided to enact some policies to reassert their power. They stepped in. They lowered interest rates, somewhat reluctantly, but agreed to do it. And the market loved it. And so we had this V. We all looked at this a year ago and said, well, I hope we made a few purchases when we had the V. And of course, that's exactly what we did for our clients, just as we did in March and April of this year. So we have a long-term faith in the market, and a dip in the market is an opportunity to buy, just as a rally presents us an opportunity to sell. And I don't think we're too special in calling that insightful strategy, buy low and sell high. I think most people would sign on to that. But when the heat is on, it can be a very difficult trigger to pull, but that's exactly what we did towards the end of 2018, early 2019. That's exactly what we did in the spring of 2020. I don't know if we're going to get another dip here in the next few days, but this buy low, sell high strategy is really kind of a key to making volatility work for you. So I just wanted to offer people that perspective and just get people to ask themselves how many remembered that we were talking about this a year ago. Just coming back to the most recent quarter, all green arrows. Again, this was through September 30th for one quarter, and we don't get that many quarters where everything is green, but got another one of those, which ought to make us feel pretty good. I do want to compare that to the best quarter and the worst quarter that we've seen in the last few decades, kind of going back roughly to the beginning of my professional career doing this. So we've certainly seen them that are far better. We've certainly seen them that are far worse. There's only one of those quarterly records that's somewhat recent, and that's the international developed market stocks in 2020 in Q1 was down about 23%. And in fact, a lot of the pain that we've had in the markets has really been in the overseas markets. A lot of that has had to do with currency. We're going to jump into that when we talk about the future here. I think we're getting set up maybe for a chance for that to reverse itself. But we did have some of the best returns in the U.S. stock market. But notice that emerging market stocks just did a little bit better than the overall U.S. stock market, which occasionally it does, but might begin to do even more in the future. So that was really the high point there with emerging markets for this past quarter. Jumping into the U.S. stock market, you'll see that large cap growth once again did the best. Small cap value did the worst. I think that we're potentially getting set up for that to change. I'm going to talk about the nature of Fed stimulus and why that could maybe not be the best thing for large cap growth technology stocks. That being said, there's also, it's worth noting, some political pressure coming from both sides of the aisle towards some of what is termed monopolistic practices by many of the large technology companies that dominate that part of the market from a capitalization standpoint. So you can talk about some scenarios that can bring some extra risk to where the biggest source of returns has been. But you can also, again, in a minute, we'll talk about why broad-based stimulus doesn't necessarily favor large cap growth stocks. Looking at international developed markets, we see that small caps did the best there. Now, we do show those returns in two forms, and the good news for all of us on the call is that it's the dark gray bars that are relevant to us because we are dollar-based investors. So if you invest with U.S. dollars in overseas stocks, you're investing in a currency and you're investing in a stock market. So when the currency appreciates, that adds to the returns that you get from the stock market. So when you hear the U.S. dollar weakened, that's actually terrific for your foreign holdings, your non-dollar denominated holdings. And so the U.S. dollar weakened considerably in the third quarter, and I think may continue to do so in the future, giving an extra tailwind to some of your foreign holdings. So parts of that market getting up there into the double digits. Emerging markets was a similar story, but actually if you just focus on the growth part and add in the currency translation benefit that we got, you're really looking at some high returns. So not monolithic, growth did the best, value did the worst, but small cap had a nice rally there ahead of large. So didn't really react the same way that the U.S. stock market reacted. Small caps have been an amazing source of returns for years in the international markets, with some years being better than others. But we've had some really big returns there, and potentially that's poised for more of a boost in the future, which again I'm going to get into in the second part of the presentation. Just making a quick comment about REITs. You can't just say real estate and cover that whole market. REIT stands for Real Estate Investment Trusts, of course. Many of you are aware that the residential housing market in the U.S. appears to be in absolutely terrific shape in the aggregate. Not that there aren't people unable to pay the rent or things going on there where there's some real pain due to the employment market. But residential real estate's been terrific. Not so much for many parts of the commercial market. You know, the strip malls, the shopping malls where the big JCPenney and Sears anchor stores are being converted to Amazon warehouses and other uses certainly is out there in the press. And I think it still remains to be seen as workers gradually come back to the workforce. How much of a real estate footprint do companies feel they need to keep? I suspect we'll have a lot more shared office space. I expect we'll have a lot more people working from home where it makes sense. A lot of companies have learned how to do that well, embrace the technology. Now they've got a run of time to see how productive employees are, but there's still a lot of questions. And so I think that might be one of the reasons that we have not seen the REIT market keep up with the broader equity market. So not losses for this quarter, but still well down year to date. So both international and U.S. real estate together combine only about 5% of the equity market exposure that we implement here at BIP Wealth for clients. And now to what I consider to be the fun part of the presentation, especially, is because we're looking forward and we're talking about the tea leaves that we're reading, the things that we're seeing. And I want to linger on this slide for a minute here. You know, the purpose of going through this is not to predict exactly what the markets will do, although you'll definitely hear some opinions out of us today, but to also help to give you a lens about some of the news we think you're going to hear so that you'll perhaps look back and say, I think BIP Wealth said something about that. Yeah, that's not a surprise. We've had a pretty good track record of highlighting issues that then came to the forefront in the months following our quarterly market reports. And here's what we're looking at right now. The Federal Reserve has always had a reputation as a market influencer, and there's always been this maxim, never fight the Fed. when you're investing, with the idea being that if the Fed is trying to stimulate the markets, you really don't want to bet against them in that. And so that's been out there for a long time. That's nothing new. But I do want to explore exactly what it is the Fed says it's going to do and what that could mean. Now, let's remember that the Federal Reserve in the United States really has three different mandates that come from Congress. And the first, and what is often seen as the most important, is to promote full employment. I'm going to show you some data about that. They're also tasked with keeping prices stable, which many people will frame as fighting inflation. We're going to talk about that. And then lastly, about keeping long-term interest rates stable. You don't hear about that one as much, but it is one of the three parts to their mandate. So they're handed this by Congress. That hasn't changed in a very long time. It may or may not change in the future. However, the Federal Reserve about a month and a half ago decided completely on its own that it was going to take that congressional mandate and reinterpret it, at least in terms of the policies that it was going to put forward. It's always assumed that they equally weighted all three, and that's part of the problem is some policies prioritize one over the other. So it was always this balancing act, this very difficult balancing act. Well, I think what the Federal Reserve has told us is that the balancing act is over. Essentially, they're going to take their first mandate that I listed, employment, and treat that essentially as if it's their only mandate right now and really just not worry about the other two. And I think that has profound implications for the market. Let's go to the next slide here with employment and look at what's been happening in employment. Well, you know, it wasn't that long ago that I was worried that employment was actually getting too tight. A lot of employers were really searching for workers. Now, that is not the case in the aggregate anymore, although clearly there are still certain industries that are desperately looking for people. But in the aggregate, employment kind of fell off a cliff. We all know the reasons why, and it has started to come back, but it isn't back yet. So we're going to talk today about what the Federal Reserve is going to do to change the markets, but their task is not to change the markets. Their task is to change the economy. And so they're going to look at this slide, the data behind this slide, and say, we've got a lot of work to do. And so in prioritizing or even just sort of isolating employment as their mission, what they have said they will do is they will keep short-term interest rates low indefinitely. And there's been a few hints at how long that might be. In many cases, they say that they're talking about 2 or 3 years, maybe even at a minimum. And so I'm really looking at the next half a decade and expecting it will be virtually impossible for people to even come close to keeping up with inflation by investing in cash. Even the teaser rates that are out there these days for savings accounts and things like that are seeing their rates get lowered and everything's headed to zero. And what the Federal Reserve has said is just expect that to continue. Let's take a look at the next slide and look at inflation. And you'll see that inflation took a little bit of a dip, but it's basically come back. And PCE stands for personal consumption expenditures. It is a very particular way of measuring inflation. That's not the CPI that you see in other measures, but it's essentially the same thing. It works about the same way. And what we've seen is that there, has been a little recovery in inflation. We're still just a bit below 2, depending on how you measure it. And the Fed's goal has always been 2. Well, what the Fed has said now is, well, that's not really our goal anymore. And 2 is probably not enough. 3 would certainly be fine. We'd be okay with that. But essentially, we're not going to worry about it. In other words, we're going to focus on employment, and we don't really care if we generate inflation. Now, I think the Fed is probably worried that we might become another Japan and slip into deflation. And negative inflation or deflation or disinflation, however you want to term it, is not a good thing for an economy, because when you suspect that prices will be cheaper next year, you tend to delay your purchases. But if we think things are going to get expensive next year, we often will buy that house, buy that car, buy the whatever it is we're thinking about buying, durable goods especially, get a boost from that. And the Fed has said, we're not worried about inflation. And so we may see inflation creep into expectations. And if we're used to 2, then, right now we can say, well, if I make, 0.1% on my cash and I lose 2 to inflation, I'm really losing 1.9% per year being in cash. What if inflation goes to 3? Maybe we're losing closer to 3% a year. And I think that's a very real possibility because the Fed is going to continue to keep their foot on the gas, continue to keep overnight interest rates extremely low, essentially at 0, even if they let the inflation line out of its cage. So that's a really different way of thinking things, and a bit of a surprise that they would reinterpret their congressional mandate. If we look at interest rates, we can keep in mind the third congressional mandate, which is to keep long-term interest rates at a modest level. That's not really a problem right now. If we look at the top middle of this chart, we can see the kind of interest rates we were talking about a year ago. And that's that gray line. And again, the Federal Reserve had started lowering short-term interest rates, still needed to lower them some more to catch up to the market. Short to medium rates and longer-term rates were already lower, and they were in the business of catching up by lowering short-term rates to try to get a straight line. Well, we've got a fairly straight line now. Short-term rates are low, long-term rates are higher. Let's talk about how this works. If the Federal Reserve is successful, and this is the organization that said they will do whatever it takes with infinite amounts of money, they are going to keep short-term rates low. They're going to anchor that end of the yield curve to 0. If it's successful and that stimulates the economy and that causes people to begin to worry about inflation and that causes jobs to come back, we should expect to see the long end of the yield curve march upwards. Now, if you own long-term bonds, that can be a very bad thing because if you own 20 or 30-year bonds, you can be losing 10% a quarter in price when the long end of the curve really moves upwards. You can also be hurt in the middle of the curve, and if you're on the short end of the curve, you don't get hurt, but you're still not making anything because the Fed is going to keep it at 0. So there's not many wins available in the math when short-term rates are anchored at 0 and long-term rates are moving up. And long-term rates have started to move up. So again, if the Fed is successful, we'll see the short end of the curve, the overnight rates stay at 0, long-term rates move up. Now, maybe at some point there's a great opportunity there. It's not that many years back when we could have gone out and bought 30-year Treasury bonds and locked in 5%. And that certainly seems like an attractive proposition these days. So there will be some point when the time might be right to go long, but we literally might be looking 3, 4, 5 years into the future before that trigger would get pulled. So rates are amazingly low now, and the short end of that curve is going to stay there. Looking around the globe, what we see now is that all of the major issuers of sovereign debt are essentially in the same position. Short-term rates are low, long-term rates are higher, and that actually is good. That is the market telling us that it expects economies to expand. So the markets are looking past the pandemic. The markets are looking into the future, whether that's 3 months or 6 months or farther, whatever it might be, when we certainly expect that there's going to be vaccines available for COVID-19. So there is kind of good news in the shape of those curves, but the short-term rates are at 0. So all the central banks are putting their foot on the gas. Where things differ is that many central banks do have a mandate to pay attention to inflation, and none of them that I'm aware of have issued any kind of expectations for the future that says if long-term rates drift up, they're going to ignore that. If they get inflation, they're going to ignore that. So one of the effects of the U.S.'s policy is not just what does the curve look like, what are short-term rates going to be, but what are they going to do a year, 2 years, 3 years from now? And what they're saying is they're just going to keep short-term rates low. And that has another effect. that tends to depreciate our currency because you can't make any money investing in the dollar itself because that's an overnight investment and rates are at zero. So we're going to talk about the currency effect a little bit. If we look at what happened in the third quarter in developed markets, all of the major currencies appreciated against the dollar. Okay, the Hong Kong dollar just barely, but every other one appreciated. So with everything going on with Brexit, remember that? Brexit, we haven't had a reason to think about that much lately, but that's got all kinds of problems. That's actually not going well, and yet the British pound appreciated against the dollar. So almost every major currency appreciated against the U.S. dollar in the developed markets. Now, emerging markets were a little bit of a different story, but you've always got some craziness going on there. If you look at things going on in Turkey and other places in the emerging market side of this slide, when that comes up, you'll see that there was, of course, a spread. And emerging markets always have this kind of a weird spread. It's always more volatile. You just can't make as much of that. But, Russia's having its issues. Argentina's having its issues. Turkey's having its issues. One of these countries is always going to be having its issues. But you certainly see many countries that are appreciated against the U.S. dollar. And I think that the Fed's signal to keep interest rates low for years to come may very well continue to pressure the dollar down. Now, that's not a bad thing if you're an investor. It means your international investments are instantly worth more when those foreign currencies appreciate that way against our currency. It also gives a nice tailwind to the U.S. to the extent that we're able to export, which does require that markets function and economies not be shut down because of the pandemic. Then that gives an extra boost to U.S. exports. So every part of your being a stock market investor benefits from the U.S. dollar falling. Again, your foreign investments become worth more just because of the currency effect, and it gives a boost to your dollar-based investments because those industries become more competitive on the global stage. So the U.S. dollar falling is great for the U.S. economy. It's particularly good for the U.S. markets because economies respond slowly, markets can respond instantly. So there's a whole lot of things that the Fed is doing and communicating with this new policy it has that should be good for U.S. equity investors. As if we needed one more chart to kind of confirm things, just look at commodities. Now, some of you are very familiar with the story around carbon-based energy, and when you have economies pull back and get slower, and you combine that with ever-increasing supply from fracking and other technologies, you just see a really hard market for oil and oil-based products. But lean hogs got way more expensive. Zinc got more expensive. Wheat got more expensive. Natural gas got more expensive. Copper got more expensive. Coffee got more expensive. All these other things got more expensive, and that is typical in an inflationary environment. That is typical when the U.S. dollar is weakening. Again, those are good things, but what we get is inflation, and we have a Fed that says they're not going to worry about that. So if you're worried about inflation, you don't want to be loaded up in cash. You don't want to be loaded up in fixed income. You need some equity exposure. You need some things that stand a good chance of beating that rate of inflation because everything could begin to get a little bit more expensive. So there's a price to be paid there as a consumer, but you make that up in your portfolio if you stay invested in the stock market. Just to take one more kind of look back and make the point one more time, I think this quarter that we just had might be typical of what we see in the future in many ways. When we look at what performed well and what didn't in the third quarter, what we see, again, is that risk on trade. So emerging markets, in this case, emerging markets, small caps did the best. What did the worst? Still positive, but did the worst? 1 month U.S. Treasury bills or cash. Barely moved at all. So again, what the Fed has said is we're going to keep the bottom part of that exactly like that. Count on that being the return out of U.S. Treasury bills for years to come. Now we can talk about that, what that means if you're an economist. We can talk about what that means if you're a consumer and so on and so on. But let's just again talk about it if you're an investor. If you're told that you will be punished for being safe, not just get a modest return, but you'll be punished. If inflation can be 2 or 3% or maybe more, and you're going to make nothing being safe, what you're really looking at is the guaranteed loss. So we often talk about low volatility investments as a good thing, but if what is actually happening is you're being guaranteed a loss, what might the markets do in the aggregate? I mean, we can come up with a reason why just about everybody needs some safe assets. If for no other reason than we've got something to tap to make a few purchases when markets dip. But what happens to markets in the aggregate? Risk gets rewarded. If you weigh the chance to make 8% in the long run with equity markets, yeah, there's volatility, but we all know about that. Or lock in a loss after inflation to literally guarantee every day that you're losing money. What might markets do to respond? Well, the risk on trade has every reason to continue. Now, that can run too high, that can run too long. Some of you may remember the words irrational exuberance that were uttered by Alan Greenspan so many, many years ago in response to how markets were going up without seemingly paying any attention to the fundamentals. So it doesn't always end well, but it can go on for years and years and years, and that is one of the things that the Federal Reserve was trying to communicate to all of us on the call today, is that you're going to be punished to the extent that you want to be safe. So again, there can be very good reasons why that is a part of your portfolio. But if you're thinking of sitting back, being in cash, pulling out of the markets, because at some point things will get better, whatever that means, then just understand what you're doing. You're really locking in a guaranteed losing strategy in the markets. Now, we showed some charts about some things that didn't look too good yet. Talked about employment in particular. Let's look at retail sales. Now, I know at least one of our clients on the call here is like me and a cyclist. I'll tell you this, if you were thinking about getting your kids or grandkids a bicycle for Christmas, you better start looking now, because that part of the industry is running at double its normal capacity. We're not talking about supply chain problems. We're talking about all the Asian bike manufacturing centers running 24/7 trying to keep up with demand. Maybe some of you have a child, or even you yourself were thinking about buying some roller skates. Well, that nice pair of roller skates that a year ago you could have picked up for a couple of $100 might be available used on eBay right now for $800 to $1,000. I mean, they just can't make the things fast enough. Sales have skyrocketed. Buy an off-road vehicle. Try to buy a high-end pickup truck. The manufacturers can't make enough $100,000 plus pickup trucks these days to come close to satisfying demand. Try to buy a boat. Try to buy an exercise machine. Sales are just going terrific. It's not just that it has fully recovered. I'm understating things there. Even with the dip that occurred at this point, they're actually tipping up. So there are many parts of the market that are doing terrific, and they don't always grab the headlines, but you might notice it as a consumer if there's certain things you're trying to buy. And residential real estate construction. I mentioned earlier that the housing market is just booming. Volume is high, prices are going up, and you can make sense of some of that. There's a good story to tell, to the extent that people are working home and frankly anticipating that they may continue to work from home a lot more forever. Again, employers are kind of figuring out how to do this better. People are looking for bigger houses. Mom and dad both need a home office now. People are looking at building pools and doing other stuff and wanting a bigger place for themselves and for their kids to recreate that maybe are not out in public as much. They want to get the basement if they live in the part of the country where they can get that. So housing is doing terrific. There is an absolute shortage of supply that's driven lumber prices very high. There are issues there, but housing market is going great guns. So a big dip, fully recovered, and even now actually starting to inflect upwards as if the dip had never even occurred. So this is one of the things that you get, I guess, when you have a pandemic. But the bigger story also is tied back to the fact that the Federal Reserve is lowering interest rates. So we've been talking about what that means as an investor. When you're an investor in fixed income, you're a lender. And so you're lending money to others at a very, very low rate. Well, sometimes people are borrowers, most often in home buying situations. So it's a great time to borrow money to buy a home because it is so cheap. Now, that applies to businesses and all sorts of other environments, but in particular, if you're in a home, and actually aggregate measures of U.S. Credit scores have shown that there's a lot of pretty healthy borrowers out there. There's been a long-term trend of improving credit. Now money is super cheap. So I would expect the residential real estate market to do well for quite some time, and the Fed has definitely become their friend. So this is going to have a huge impact on all sorts of goods. It'll help with jobs. It'll create some inflation. It will benefit the broader economy in every possible way. So as we're winding up here, I wanted to turn attention to something that I just really alluded to before and put a chart in front of you. Now, this is an interesting chart. You might not have seen this before. We're going back in time almost a century. And what I'm showing you in the kind of yellow-green color there are years when value stocks did better than growth stocks. So value stocks are cheaper stocks to buy. You pay less to buy the earnings of a company when you buy a value stock. Growth stocks can be very expensive. There may be little or no earnings there, but when you buy a growth stock, you're really buying it with the expectation that it'll grow in the future. And so on the bottom end of the graph, there are the kind of pale teal bars that show you when growth stocks have done better. Well, in the last few years, growth stocks have done better than value stocks. That's not a surprise. We saw that in some of the charts. And those are all the popular names, the stocks that everybody loves right now, the large U.S. tech companies in particular that have done so well. But just looking at the chart, you can tell that there's a lot more years when value stocks do better. In other words, common sense does prevail over the long run. If you buy stocks where you pay less for the earnings that are there, that's probably the best deal going forward. And so on average, value stocks have outperformed growth stocks by more than 4%. So it is not a small gap. It is a huge gap. Now, one can do the quick mental experiment. One can go back in time and imagine ourselves as the investor when growth stocks have done better. You know, how many years would growth stocks do better before you threw in the towel on your value investments and you loaded up in growth? Well, the growth rallies don't last that long. Certainly, many of us on this call, many of us that work at BIP Wealth, were in the business back when there was the big growth rally in the late 1990s. Everybody thought they were a growth investor until growth stocks got just annihilated, and then everybody wanted to be a value investor, and was for a long time. But then eventually growth reasserted itself, and everybody who wanted to be a growth investor, we all kind of want to be whatever has worked of late. So BIP Wealth's approach to this is to have a modest tilt towards value, to have it be a permanent kind of thing. You never know when the growth rally is going to disappear. If we get a lot of bad headlines, whether it's because either or both political parties are re-regulating growth companies, or it's just because a broader rally is the natural result of the kind of Fed stimulus that we've talked about. There's nothing about the Fed stimulus we talked about that necessarily rewards growth stocks. You can even argue that it doesn't, that it places a premium on value stocks because there's a source of cash flow that is well above what you're going to earn with fixed income, right? Value stocks are where the dividends are. So there's lots of reasons to believe that the growth rally is near the end of its days. So we'll see. We're going to look into the future. We're going to look back at what's happened over the last century and place a long-term bet there. But there's lots of reasons to suspect that we might start to see the yellow-green lines shooting up above again as value stocks come back into favor. A few disclosures to read there. But let's look at this picture here for a minute. This product contains peanuts. I don't know how many of you have seen that somewhere on the internet. When we look at that label that was put up on a grocery bin where someone was someone was probably meeting a regulation that said that label had to be there, we all just chuckle. And the first reaction is look at that silly government regulation that required that. What a silly rule. But I've often thought that we need to put up some kind of rule around investing in the stock market that follows that theme. The market always contains stocks. Stocks are always volatile. For some reason, people look at investing in the stock market not as this scary, dangerous, agonizing thing to do. I guess we all maybe have memories of a time or two here and there where investing in the stock market seemed to be easy. If you look at the long-term charts, it seems like it ought to be easy. But investing in the stock market always comes with big ups and downs. And so maybe we just need to put up a sign. This market contains stocks. Seems self-evident, doesn't it? But the stock market is never going to get better. So this past year so far punished the doubters. We had a big dip in the stock market, and unless you told us to pull back on your exposure, if you didn't want to stick to your long-term plan, then we bought stocks on the dip. We did that the year before as well, when the stock market went down. This volatility really can be your friend. And so I just want to remind people that the stock market is always going to be volatile. If your thought process at this point is, let me wait until the all clear, let me wait until I get a political outcome that I like, let me wait until it's safe again to invest in the stock market. It's never going to be safe to invest in the stock market. It's always a volatile thing where it could dip at any moment in a major way. And I will have to say that, in the current environment where everything's politicized, if you're looking to the upcoming election as the excuse, I would encourage you not to wait. I mean, it's really right around the corner here, but for those people that might have pulled back from the stock market when Donald Trump first got elected, then if you didn't like those politics, you really transferred wealth to those that were willing to stay invested. If you did the same thing back when Barack Obama became the president 8 years before that, you missed a market that averaged right at about 11% a year for the 8 years he was in office. So one way or another, if you're investing your politics and you get that wrong, you're really transferring your wealth to people that have a different political point of view. So the real lesson there is just stay invested. Because we buy on the dips and because we take profits on rallies, volatility really benefits investors. It gives us more chances to buy low and sell high. And so what we hope is that everybody will be long run in their thinking. They'll look to stay invested in the stock market. They'll understand that that's always got risks to it, but we have the tools to deal with that. And that these long-term trends, including value beating growth, are things that are entirely based on data. So it's got to be this long-term approach. And so that's coming to the end of my comments. I know we're going to have some questions and some other things I'll be excited to talk about. But Bill, back in your court.
Great. Thank you, Eric. Nice job. And so as a reminder for everyone, there is a toolbar at the bottom of your screen with a Q&A icon. Feel free to type in your question and we'll get to as many of them as we can. The first one, Eric, comes from Dave. And so the question is, please comment on how BIP private equity has compared to the other asset classes you have already commented on for the past year or two, and what should this asset class look like going forward for the next couple of years, comparatively?
What a great question. I was hoping I'd get one like that. There's so much to say. So, it's interesting. We model that the returns from private market equity will be higher than the returns from public market equity. Now, every private equity investor has a different portfolio, and that kind of activity is often spoken of in vintages. So, The new investments that were just made in the last year or two haven't had much time to grow, although many have. And ones that were made 5 years ago and 10 years ago have in the aggregate done extremely well. So no two portfolios are exactly the same, but for those people that got into things 5 years ago, that got into things 10 years ago, they have been very handsomely rewarded for tolerating that illiquidity, for being invested in something where they didn't have the control. They couldn't rebalance it when they wanted to. That patience and that determination and that trust has been rewarded in major ways. In fact, the returns have been so high, I'm always scared to even mention what they are, because people tend to want to think that they'll always be that good, but they've dwarfed what we've been able to achieve in the public markets. And we do model that they will return higher than in the public markets. Now, talking about going forward, I don't think there's any reason for that to stop. There are so many fewer stocks available in the U.S. public stock market than there were back when Bill and I first started in this business. We used to have an index called the Wilshire 5000 we talk about. There's barely 3,000 stocks in the U.S. stock market now. Private equity is bigger and bigger, and the public piece of it is smaller. So really, if you just want to be diversified, you probably need to be investing in the private markets, just to have more opportunities that are out there and not just a part of the shrinking number of U.S. public market companies. I am probably the most excited, though, about the private fixed income side of things. You've heard me talk about public fixed income and what that might look like going forward. We've been working very hard over the last couple of years to find more opportunities for private fixed income, and you're going to see that effort continue. And so what I'll often talk about in individual client conversations where it makes sense for that client to do it is, hey, I might actually be fairly excited to be able to earn 2% in public fixed income in the coming years, certainly based on what the Fed has said that they're going to do to yields. But we have had in the past and expect to have in the future private fixed income opportunities where the current yield is going to be into the double digits. And so just in the most simplistic terms, if you're weighing 2% and 10%, you can say, which one would you rather have? Now, that's not the end of the analysis. There's a lot more things to consider. But looking forward for the next year or two, the thing that I consider about private fixed income is that unlike the stock market where, we're talking about high single digits, but you need to keep the faith sometimes for a decade or more. When we're talking about private fixed income, we're often talking about, yields where you might be yielding 3% a quarter. So you don't have to wait to get the cash flow that comes out of that. You don't have to wait to get that return. So as long as you get your principal back, you're really earning very significant returns on a quarter by quarter basis. And you could look at investing $1 million in the private in the public fixed income market. You might have the same amount of cash flow with $150,000 in the private fixed income market. So the gap between public and private is probably going to be the greatest on the fixed income side, and especially in the next year or two.
Good. Thanks, Eric. Please feel free to type additional questions. Would love to see some communication from the audience. I'll throw a question out there, Eric, for you. You were talking earlier about value stocks and the dividends being paid from value stocks. So as an investor, why wouldn't I just go ahead and load up a portfolio with dividend paying stocks that are paying me 3 or 4% as opposed to the public fixed income, which might only give me 1% return?
Well, it's not an irrational thought, and it is one of the reasons that we have a long-term bias towards value stocks. But that metric that you consider there, what is the yield out of the stock market versus what is treasury yields, is part of the math that I think the Federal Reserve is counting on us all doing. When you can't even earn the dividend, you can't even earn the dividend by investing in fixed income that you could get from some dividend-paying stocks. It certainly seems like a worthwhile thing to do. Now, I'm going to give you a little bit of math. It gets a little bit more complicated there in that answer. If you look at the long-term basis of outperformance of value stocks, it doesn't appear that it's the dividend per se that's generating that. It appears to be the fact that just the stock is cheaper and what you pay for the earnings is cheaper. So the dividend is more of an after effect. So screening for the dividend might not be the perfect way to find that, but the concept of value stocks and inexpensive earnings being a source of higher future return is very definitely something that we believe in. And then sometimes you just get that extra dividend as an after effect of doing it. So we have a very precise way mathematically of identifying how to do the value tilt. It does often result in a higher dividend outcome, though.
And what sort of dividend paying strategies do you include in the portfolios, Eric?
Well, again, it's the after effect of being invested towards the value tilt in general. That being said, there's other things that we do with options to create a synthetic yield that is particularly high when volatility is high, that also creates cash flow. So when I'm looking for cash flow, what I also know is, at least under current tax policy, and I'm not sure this is going to change, you can create your own dividend anytime you want by selling and taking capital gains. So interestingly enough, if you stick to the discipline of buy low, sell high, when you get to the sell high part of the rally, you're really making your own dividend. So we're really investing for total return. But if you're really just looking for cash flow, I'm actually going to go back to the private fixed income answer I was given a few minutes ago. If you're looking at yields out of these instruments that are in the double digits, we're nowhere near being able to achieve that in the stock market. So for pure cash flow, that's pretty hard to beat.
That's good. I like the focus on total return and not just on yield. I think that's an important point. So James is sending a question. What is the downside of the Federal Reserve's all-in policy?
Well, it's interesting. The Fed is really, I think, reacting to the economy and reacting to, let's say, some of the uncertainty about the fiscal and the policy response about where the economy is going right now. They're basically taking the bull by the horns, if you will, and saying that they're gonna do this. There's actually an upside. I just want to sneak into my answer to the question, which is to say, by keeping short-term interest rates low, the cost of all this government debt we're incurring is actually a lot less. Some of you may have heard me mention in the past that the average Treasury obligation matures in just about 5 years. So when short-term interest rates are low, our borrowing cost at the federal level is much lower as well. So that means that the amount of the federal budget being dedicated to paying interest on this gargantuan and growing national debt is much less. So there's the benefit. What I'd say is probably the biggest downside in doing this, and the downside of the Federal Reserve intervening in the capital markets in such a significant and meaningful way is that they could at some point unleash inflation. And those of us that have a few gray hairs or actually just happy to have a gray hair will remember way back to when inflation was a real problem. And we had to go to great lengths, including jacking up interest rates very high, to put that inflation genie back in the bottle. So one of the potential downsides of this is that at some point we really do get some runaway inflation. And we haven't had to worry about that for quite some time. There are reasons, including technological advancements and productivity advancements that I've talked about before, that I think are going to suppress inflation. So the Fed might not have to worry too much about that for some time to come, and I think that's probably informing their policy. Again, all these efficiencies that are created with technology are disinflationary. But another downside that's worth mentioning is that at some point, maybe years down the road, the return on safe investments has been so low for so long that maybe we've watched the price of the stock market double from where we're at right now. We could be in for a correction that's even bigger than anything that we've had in recent years, maybe bigger than the Great Recession, maybe bigger than the technology bubble bursting. I think that would be the product of the stock market run going on for years and years and years and years and years. So I don't think that's around the corner. I think that's the kind of thing we're looking at, 5 or 10 years from now, when the stock market is more than doubled from where it's at. So if your strategy is to never be quite all in, always have some safe assets, and to take profits when the stock market runs up, you'll do okay with that. But I think the downside is that we get irrational exuberance again. And at some point, Bill and I are talking about, can you believe the Dow just, crested 50,000 or 60,000 or something? That's when I'm going to worry about that. But who knows? Maybe the Fed keeps their foot on the gas for that long.
Good deal. Well, thank you, Eric. We're at the top of the hour. And the last comment here from Jay, thank you, Jay, was really wishing us to stay safe and healthy. So Eric and I would like to hope everyone stays safe and healthy on the call. Thank you very much for joining us today. And please take care and look forward to speaking with you again soon. Thank you.
Thanks, everyone.